Great, thank you very much. I'm going to talk quickly about the global macro themes, really the drivers of currencies for intermediate term time frames. And I have to admit, this year has been a terrible year for even focusing on global macro themes. The central banks and the liquidity-driven markets have been really the drivers of currencies, and if you just followed risk on, risk off, the pack tended to move together. I've been doing this for a long time, basically covering international markets for about 25 years in various forms, whether it's research analyst, money manager, trading equities and bonds globally, and trading currencies. But this year, I'll have to say, is the toughest year I've ever seen for applying global macro analysis to currency trends, the euro being a prime example. But that being said, I've been doing these newsletter trading Forex since about 2004 in Black Swan. And I think over time, knowing the global macros, or at least understanding the themes, has served us pretty well. Alex just commented in here about the yen, and I think the yen is one of those situations which the global macros are starting to trade out, and I will cover that in detail because it's one that's starting to click here toward the end of the year from a global macro standpoint, and I think it has a lot further to go, and I'll explain why. I won't bore you too much with what's going on in Europe. I think most people have understand the structural situations covered pretty clearly. However, I will touch on some key points and some still remaining risk here, what's going on in the euro currency. So let me get started here. There's our disclaimer. General agenda, going to look at the themes, as I said, and go through each of these, and we'll get to them instead of covering them. I still think the major thematic in the world economy is this idea of global rebalancing. And what that means is you have the countries or the regions, thinking Asia primarily as the poster child for this, as the major current account surplus nation. Japan was a big current account surplus nation. And the U.S. is the big current account deficit nation. This whole process of the credit crunch, the credit crisis, really is a process of rebalancing, and we're starting to see it play out. And I think that's going to have some drivers of be a big driver again of global macro trends in the currencies once we get past all this central bank stuff. And I think we're getting close with Bernanke's last pronouncement. We're getting close with the ECB basically shooting its wad here once we get through the next so-called bond buying situation. I think the global macro trends will start reacting on these currencies and help define some of these trends. And I think just having a market view with your technical view in general is helpful. Of course, if you're trading in very tight time frames, if you're swing trading intraday, it's probably not the case. But if you're holding or position trading anything overnight, I think having an understanding of the market view helps. And if you step back and you think, what is the biggest global structural change going on in the world economy, it is still this idea of too much debt in the economy, in the world economy, thrown out there by all the major countries, including China, and the process of deleveraging on the consumer side, which we're seeing it's still taking place. And continuing in the U.S. That's why the Fed money and the stimulus from the government hasn't been stimulative. The private sector is still deleveraging. Are we close to a bottom in here? I don't know, but I still think there's more to go. There's especially more to go in Europe, more deflation taking place. So as we see this this connection between the rebalancing of surplus to deficit and the U.S., although its deficit was down, had a greater trade deficit this latest pronouncement, and the reality was it reflected weakness in the global economy because exports were down and imports were down. But in general, we're seeing the current account deficit in the U.S., which has been a big driver of expectations that the U.S. is so dependent on money flow externally. We're seeing that change, and we've seen the U.S. current account deficit improve dramatically, and that doesn't happen in isolation. In the global macro world, if one thing happens, there's a reaction on the other side. So we're starting to see Japan starting to run trade deficits for the first time since the early 80s. We're starting to see a change in China's export components. So this process is taking place in a very big way. It does not have to be bad for the global economy, But in the midst of this structural change, it is a little bit dicey in that we have a world in which the industrial world economies are running on below trend growth. Some people don't think now and going forward, because of all the debt that the U.S. government has thrown into our economy, that our growth prospect may be 1%, 2% over the next 5 to 10 years, and who knows, maybe we get into the Japanese type of trap and we're in there for 20 years. It's a very plausible situation, and because of this deleveraging on the private sector, you're not seeing the consumer rebound as they have in the past, because this cycle is so different because of the global changes, and this rebalancing is the big driver. Just to look at, despite the fact that we're seeing the U.S., if you look on this chart, this is a chart of PMIs, and the two that are above 50 now are the U.S. and China. Not bad. You want those two to grow. They have to drive the economy. However, the U.S. move is still suspect. There's no doubt the U.S. is showing signs of growth, but the job market is still not out of the water by a long shot, although jobs improved last month. Tons of people fell out of the job market. So, it's still very, very dicey out there. And as I said, the fact that U.S. exports declined and U.S. imports declined is not a good sign for the global economy. The Eurozone, which is in green here, is going deeper into recession. The UK is following. Japan is in recession. So you have major segments of the world in recession and possibly even deepening. So there's a lot riding on the back of the U.S. So if the U.S. doesn't continue to improve, it's big trouble for everybody, and especially those that are now still bullish on China. But if the global demand isn't there, it pressures this euro situation yet again. Now, we've had a window of optimism here in the euro, but that can close if global growth doesn't come around. So we're watching these, continue to watch the PMI numbers, but continue to watch the employment numbers. We saw Bernanke come out this week, just this week, and the whole changing dynamic, and to me it's kind of a Hail Mary pass, tying U.S. interest rates for some reason to U.S. employment. Now, given the fact that the job market is still very, very dicey, the idea is now we have perpetually low interest rates. And the fact is, many people have said this before, and I've been saying this for years, that the idea of zero interest rates actually hurts employment, and it does it through kind of a feedback loop. When Bernanke pushes so much money into the global economy, or attempts to, he creates inflation for those goods that consumers buy, and we have to buy. We have no substitute. Gas, food, and little things like that. So the job market's stagnant. The wage market is stagnant. So as he pushes interest rates down to zero, it increases the cost of those goods for consumers, so the real income actually declines as he continues to maintain zero interest rates, but juices these other commodity markets, whether through risk on, risk off type of situation. So that's a major problem. And he's also destroyed what's called the interbank lending market. And I don't want to get into this too much. It's very esoteric, and you can look this up. But the reality is the interbank lending market is the way in which money gets from the Fed or the banks into the real economy for real opportunities. And when you have zero interest rates, banks aren't willing to lend or take the risk in the marketplace or lend that money to smaller banks that would have opportunities out there. So the idea that zero interest rates are such a great thing in the world on so many levels is proven wrong from economic theory and reality as we watch it. On the right side is the euro, and you can see here the Eurozone economies. And the only one doing well of late is, of the periphery countries, is Ireland, and they've actually bitten the bullet and things are coming around. But their debt-to-equity ratio is still rising, and it's still a question of whether or not they can come out of this. So although there's some optimism, again, in general, the growth rate for all these countries is continuing to fade, and this recession is getting worse despite all the PR that we've seen from the European leaders. From a currency trading standpoint, I think the first decision you have to make is what's the dollar going to do? And that has to be generally your bias, because the major currency pairs are traded against the dollar. They're all traded against the dollar. You can't trade a currency in isolation. The major pairs include, of course, Japanese yen, euro, Swiss franc, British pound, Canadian dollar, and Australian dollar. They're considered the majors. So your dollar bias view will then come first in terms of your time frames as you trade the other currencies that are linked to the US dollar, the major pairs, those that are so actively trading, those that Dan talked about that are available on NADEX, excuse me. I generally think the dollar has bottomed, and I've been saying this for a long time. My view was that 2008, the credit crunch, really was a sea change in the global economy, and it would trigger what we've seen here, this idea of rebalancing. Rebalancing is generally going to be good long-term for the U.S. The pain, obviously, is there during the transition. But long-term, if the U.S. exports more and Asia buys more, Asia has to buy more first before the U.S. can export. But if that process takes place, it's generally going to be good for the U.S. dollar long-term, despite all the other warts that we hear about the U.S. And the dangers are real. The U.S. potential for a real sovereign debt crisis is very real. But when it comes to currency trading, the other thing you have to always think about is that this is always a relative game, and it's quite different than other asset classes. You can evaluate other asset classes, stocks and bonds in their own right, cash flow, those types of things, quality of management. The currency trading game always has to be evaluated one currency against another. So if we know that the U.S. is doing badly, it doesn't necessarily mean the U.S. dollar is going to fall because somebody else out there may be doing much, much worse. And there's always that stuff that's underneath the surface we don't see in terms of money flow and risk, major portfolio risk flowing from one country back into the U.S. capital markets. The U.S. dollar in general is very, very lucky. We probably would see the dollar much, much lower if it were not the world reserve currency. And the fact is U.S. policymakers aren't respecting the fact that they have the world reserve currency. What I mean by that is when we had the global credit crunch, a lot of it came out of the U.S. real estate market. The derivatives market was kind of the trigger for the credit crunch. And everybody said, well, the U.S. caused all these problems, get out of the dollar. But what happened was during the credit crunch, as you can see here in 2008, the dollar bottomed. And it bottomed because of the fact that people had to come in and hide in the U.S. capital markets by virtue of the world reserve currency, the deepest capital markets. So it's dodged a lot of bullets in here. The question is, can it dodge the bullets going forward? And that's why I think the global macro side is important to look at. There's risk here that the dollar may turn around and tank again, but I think in general, my story is, and my bias is, longer term, it continues to move higher. A question here from Ken about whether or not the loonie is a reserve currency. You're seeing a shift, no doubt a shift into currencies like the loonie and in the Kiwi to a degree, but also the Australian dollar as an attempt at reserve currency. But the reality is those markets are much too small to become reserve currencies, but they're benefiting mightily from places to hide when you look at the major currencies, i.e. the yen, the US dollar, and the euro as real basket cases. So it generally is going to push up, generally be supportive of those precisely because people are looking for other areas to hide and other areas of safety. It's a great question, Ken. Thank you. This is a look at, as you can see, kind of a risk on, risk off that we've been seeing. This chart shows the Dow Jones Industrials, and we do a fair amount of correlations, and we keep it very, very simple. And the US dollar index is here on the bottom. We were seeing a very tight correlation during the entire 2000s when we had that whole symbiotic relationship with China when they were funneling money back into the U.S. and everybody was looking to move their money out of the U.S. So we saw the stock market rising and the U.S. dollar going down point by point, almost in direct correlation. And then, of course, a little thing called the credit crunch and the stock market tanks, and here's the U.S. dollar rallying. People would say, well, that's perverse. Why was everybody running from the stock market? Is the U.S. dollar rallying? It's rallying because of the fact that the U.S. dollar made a major move on the safe haven status. As I said, people just portfolio flows back in the U.S. not because they like the dollar, but because they had to buy our treasuries. So I see a a comment in here from Ishwar. China is planning to bring the U.S. dollar down. There's no doubt that China, we can get into this, and I'll get into this a little bit on the Chinese slide. There's no doubt there's things taking place that suggest that China is going to be the longer-term reserve currency, but you have to understand you can't just flip a switch in the reserve currency. You have to have a lot of things in place. China isn't there yet, although they'd like to be. They don't have the open current account. They don't have capital account. They don't allow people to come in and buy assets. They don't have the sophistication yet in their derivatives markets, but they're getting there, and they're using Hong Kong kind of as a place to do that. We're seeing more and more yuan deposits in Hong Kong, and we're seeing more and more of bonds denominated in yuan come out of Hong Kong, and we're seeing also China make arrangements with countries to do direct swaps from the central bank of their currencies in order to avoid having to convert back into the U.S. dollar to buy commodities. So China wants to get there, and they may, assuming that the growth trajectory remains the same and there isn't a major political crisis, but it's going to take several years still. But stay on that point, just to stay on that point a bit. There's no doubt if the economic wealth continues to shift from west to east, you're going to see the U.S. dollar as a percentage of holding in the central bank accounts decline. Right now it's about 2/3 of the world holdings is denominated still in U.S. dollars. But as that shifts and as China's financial markets become more sophisticated and China becomes more open, that will change. So the point here is that we've seen a pretty direct correlation in risk assets, risk on, and the U.S. dollar falling. But of late, what's interesting, we're starting to see a little bit of change if you look longer term in this correlation. We've seen the U.S. dollar rallying and the U.S. stock market rallying at the same time. People think that can't happen, but that's exactly what happened when we had the big bull market in the U.S. dollar from 1999. It started during the Clinton years and the big move in the U.S. Stock market, 1990s. In the run-up into 2000. So it was about a 10-year bull market we saw in the U.S. dollar that moved in correlation with the U.S. stock market. So that has to be one of the drivers, because ultimately a long-term trend has to be driven by some fundamental value and money coming back into the U.S. And as I said, number one is this idea of rebalancing. Number two, this idea of energy dependence. I think that is for real, whether or not it's overblown. The reality is U.S. dependence on foreign energy continues to fall. If we produce here, our current account deficit will fall. Means we won't need as much external funding, and at the same time, you'll see international money, foreign direct investment, come into the U.S. to get involved in more and more of these energy projects. That's the way a long-term trend is driven by long-term positive fundamentals, and the setup really is there for the U.S. dollar, despite the nastiness we're seeing. At home, it's pretty nasty elsewhere. European crisis. Just a few points on this. The European crisis is not one crisis; it's three. It includes a competitiveness crisis, a sovereign debt crisis, and the banking crisis. Now, of late, we've seen improvement on the bottom two, B and C. The European Central Bank has come in and said it wants to do everything it can to support the bond market, and we've seen a massive rally in the bond market in Europe. The banking sector, they've made some positive movements towards a united banking system. Still an open case whether or not it's going to take place, but it's been very positive for the euro. The problem, the area where they haven't made any real changes is this competitiveness, and the reality is if these countries cannot be competitive against Germany, their debt-to-equity ratios, debt-to-GDP ratios are continue to soar, and they won't be able to pay back the borrowings that they've made. So until we start to see real changes in that area where Germany's sucking the wind out of the entire Eurozone, I still think the crisis is upon us, so to speak. The areas now that we're starting to see whether or not this thing's really going to work, I think, is Spain. Spain really is the canary in the coal mine, given what's happening in Spain. although we've had optimism, nothing really has changed to improve the economics in Spain, and it goes to this issue that they're just being squeezed in a very, very big way. Obviously, Greece once again has been saved. Greece really hasn't been saved, but they pushed it out till after the German elections and achieved that. The European Union does a lot of PR and has gotten a lot of mileage out of this. But the reality is, and even Merkel admits this, there's no silver bullet here. The crisis will continue, and they just have to make many strides along the way. So to her credit, I think she hasn't been one to overplay this. Although, as I said, in general, they've gotten a lot of good PR out of this. The other point, which is interesting, that just started this week, is this idea that Berlusconi may be back and continue to attack Monti. Berlusconi was the prime minister that was ejected, basically, from Italy by the powers that be in Europe, and Monti, an unelected technocrat, big power player throughout the Eurozone, was installed as the prime minister. Berlusconi is still, as you would expect, very, very angry over this. And how he continues to attack or react to Monti's decision whether or not to come back into politics. Monti had stepped down just recently. Berlusconi's back and forth on this, but this could continue to play out and get pretty nasty. Berlusconi has a lot of press, a lot of ink, and still has support of one of the major parties in Italy. The reason this is so scary is if Italy doesn't continue with reforms, we could have another attack on the Italian bond market. And if the Italian bond market is attacked, the Spanish bond market will be attacked. And again, I didn't want to get into too much of the structural problems of the Eurozone, but the reality is the Eurozone has been set up in such a way that it's benefited Germany tremendously compared to the rest of the states. There's only a few charts you need to look at to understand this. This is the Euro, a picture of the current account balances of the various countries in Europe. Now just stay with me a second. This is when the euro was introduced. This is Germany's current account deficit that clicked into surplus as the euro is introduced. So effectively, these countries down here with these periphery countries have been buying a whole lot of German goods. So it's been very, very good for Germany, very, very bad for these guys. And the fact is, Germany is much more efficient at labor costs. There's when the euro started, the measuring point of labor. The idea of the euro was these people were going to make their countries much more efficient and competitive against Germany. And the fact is they haven't. And there's a widening divergence here between economic efficiencies and production. And that's what I say, that third crisis, that number three they haven't worked on, that competitive crisis, is one that is still a huge problem for Europe. And how do they get around that? The only way they can get around that is if the citizens of Europe continue to take this massive deflation, which is the attempt to push down wage rates in all these countries. Now, the level of pressure socially, as we know, looking at all the riots, has been building tremendously throughout the Eurozone. So the question really now is, will they have enough time? And that's why we step back and look at the global macro. If the U.S. doesn't rebound and provide the coverage of global demand out there, they'll have a lot less time to get this house in order in the Eurozone. And as I said, because Spain is the canary in the coal mine, we'll get to that in the next slide, we could see this idea of time very compressed, given the potential for a huge economic crisis. And some would say it's already an economic crisis in Spain, but for it to continue, because the housing market's just starting to break in a very big way, and that's going to add more and more pressure to Spain. Before I get into that, I just want to show you the European balance sheet. They're adding more and more leverage to the balance sheet. I think the leverage now is about 300 to probably about 350 to 1 on the European Central Bank balance sheet. That would bankrupt any institution. Lehman Brothers went belly up at 50 to 1. The European Central Bank is a little different than Lehman, obviously, because they can print their own currency and print their way out of this. But the reality is, the European Central Bank has been taking on very, very poor quality collateral backing all the loans that they've made. So the risk in this balance sheet is not only risk in terms of size, but it's risk in terms of collateral quality. It gets worse and worse by the day. I once said that they're now taking, 2 goats and cheese wheel now for collateral. So that's really how bad it's getting in the zone. And from a monetary policy standpoint, that is the limiting factor. You can only lend against so much collateral, and pretty soon you run out of collateral. And I think the European area is approaching that. Now, no doubt they got um, some big breathing room given what interest rates have done throughout the Eurozone, but that could change pretty easily. These are numbers just showing that the amount of lending to Spain and Italy in here. This is Italy, green. This is Spain, the gold. And so there's a bunch of money that the ECB is sitting on of these countries. And the reason this becomes, as I said, a little bit dangerous for the Eurozone, if you look at what's going on in Spain and why I say they really are the canary in the coal mine here, this shows bank bad loans in Spain, all-time high in here, especially since the euro introduction back in this area, even above the recession years in here. That's fine if you say things are turning around, but things aren't turning around. If you look at Spain, you can see their unemployment rate up here up above 25% with Greece. The other countries go in the same direction. The only one doing well here, again, is Germany, which has still benefited mightily from what's going on in the Eurozone. So Spain continues to be in trouble. Youth unemployment in Spain now is over 50%. It's just a very, very bleak situation. And what's also interesting, and is the divergence between, and let me just go back a second. I want to make this point because I think it's really critical when you think of the Eurozone because people don't talk about this too much. But if you look at the divergence here between, this is Germany, and these are the labor rates of Spain, excuse me, of France. Now, one of the reasons the Euro in general, one of the guiding tenets behind this was that France would start to contain Germany through the Eurozone. But the reality is Germany is now pulling away from France in terms of its economic efficiencies, and we know France is turning more and more socialist. So the reality is, as the two big countries in Europe continue to diverge, this will create, again, even more pressure on the zone, and it goes back to the competitiveness problem that hasn't been solved. More pain for Spain. You can see this is their Spain GDP just tumbling down. As soon as they started taking on some of the austerity measures by the Troika, which have been a disaster for Greece, are now a disaster for Spain, and it's getting worse. This is mortgages granted in Spain, tumbling. These are house prices in Spain. Interestingly, not a big break in housing prices compared to what has happened in the U.S. and some other countries when the crisis hit. So given this idea that you're going into deeper recession, your unemployment rate continues to rise, you're granting fewer and fewer mortgages, this should continue to get worse, and if it does, it pressures Spanish banks, which means more money has to come in to Spain. Switching to China, everybody's favorite. China has a lot of troubles in its own right. And the problem that it comes into, the problem for China is that its export model has changed. And as I said in the first slide, that first major slide, there's a rebalancing going on. The West is not buying as much on a relative basis as they did, and it makes sense. The European consumer's in big trouble. The U.S. consumer hasn't gotten back to anywhere where it was on a relative basis before. So what has China done? It's invested more and more internally in order to drive growth. And what happens when you have investment internally just to create jobs and drive growth, it creates a lot of capital misallocation, and we're seeing that in a very big way. Underneath the surface, the debt-to-equity ratio, the debt ratio is rising dramatically. The off-balance sheet stuff is huge. China even said it's going to stop reporting what's called its managed wealth products, which are a part of its shadow banking system, because they become so huge and becoming so risky. They're going to stop reporting that number because they think it looks detrimental to the West, and it does. So there's a huge amount of risk developing underneath the surface in non-performing loans that are not on the balance sheets of the banks. A lot of spec going on. There's small companies in China that are paying 20, 30, 40% interest rates to keep their companies going. The private side, the private small companies, the state-owned industries are getting all these subsidies because they employ so many more people. So the private side is being squeezed out and the debts are rising, and you've seen the stories. What happens is, and it happens in every country in the world, but the financial repression in China is even worse. They transfer money from the household sector, these low deposit rates, from the Chinese citizens who can't invest outside their country, so they have to put them in the bank or look for some internal investments. But in general, that money sits at below market interest rates and is used to fund this investment dependence. So we're seeing a real problem in China, and we're back to a situation, if global demand doesn't rebound, and if it doesn't rebound quickly in the US and doesn't rebound in the Eurozone, China can't create this out of nothing because of the situations that they have set up. Now, the new leadership, to their credit, understands this problem to a T, and they understand that they also need to provide a different image to the Chinese citizens, one of a lot less corruption, and they're moving in the right direction. But this transition to a more balanced economy is, again, doesn't happen by flipping a switch. It's a very delicate process, and it's a longer-term process. And the reason is you have a lot of people that have made a lot of money on this idea of export dependence and investment. That's the current economic model. And we know about all the billionaires in China and all the princes in China. They've made their money on this model. So even though the government is well aware that they need to make this transition, there's blowback and the political risk inside the country. China's penetration now, from a consumer standpoint, I think we're down to about 35% of the consumer as a percentage of GDP. That's off the charts in economic history. It literally is off the charts. So there's pressure here inside China. Even though we've seen some growth of late, the growth has come not from exports, but again, this stimulus on the investment side, more stimulus coming from the bank directly into businesses, more stimulus to try and subsidize the export side. We haven't seen a real attempt at a transition to a more balanced economy. And it will take place, and the market will force it to take place. And when it does, it's going to be good for China ultimately, good for the Chinese consumer, and probably very good for the world economy. Because once we see this transition in detail start to take place from China, and they start to allow their citizens to start buying goods from the outside, they're also going to probably let their currency start to rise. And as they start to let their currency start to rise, then we see that goods flow from west to east as opposed to just one way. And the rising currency for China is very good for it lowers their imported commodity costs. So when they can get there, and if they can get there it's ultimately going to be good. But I think these several years in here, we could see much lower growth than expected in China because this transition is going to be so difficult. And again, the leadership understands it very, very well, and I do think they're moving towards this, which is a good thing. Japan. I've been telling the story on Japan for a while, but the reality is Japan is finally starting to break. And when I say break, it used to be disaster never mattered in Japan. The rising debt, 250% debt to GDP, nothing mattered. Economics, terrible, all good. But what's, I think, the trigger is in here, and finally we're seeing it. And you know, mea culpa to me for being early on this, waiting for the trade deficit to change. And this rising trade deficit for the first time in the 1980s, that just wasn't an aberration from the credit crunch, but is we're starting to see a real sea change in this area, is something that's changing the dynamics for the Japanese yen. And let me show you the chart to describe this. This is a dollar yen, by the way, US dollar, Japanese yen. And you can see just 2007, the yen was up around 123, and it's down at 72. A longer term chart on this, and I'll show it to you, it shows how tremendous on the next slide, the pressure has been on the companies within Japan. It shows how efficient they really are. And here's the story, as I just said. I think the real sea change that we're seeing here is this idea that the economy is finally changing, in that this is the rebalancing. We're seeing this idea, we're seeing a reality of massive declines in trade in Japan, and that goes to the lack of demand from the West, as we talked about, the major global macro event. The reason this is more dangerous now is that it means that the amount of money flowing into Japan to fund their massive GDP or their massive debt to GDP changes. It starts to decline, so it adds some risk here. So it's finally you're seeing the risk and the internal problems into Japan finally feed in to the yen. So you can see this chart goes all the way back to 1984. And back here, the exchange rate was like 225. And now the exchange rate is down to 75 at an all-time low, 75 this year. Think of the pressure on the Japanese exporters going from 225 down to 75. That's a massive appreciation when looking at dollar yen. So that's an appreciation of yen. So it only takes 75 yen to buy $1 when it used to take 225 yen to buy $1. Massive pressure on Japanese industry, and this is why you're starting to see the politics change in Japan, and they're starting to finally say, and we're seeing that we're going to have an election tomorrow, that the central bank is doing something wrong, and we need a radical shift. And that radical shift is starting to finally feed into the yen. There's an interesting chart that also kind of tells the story, and something that I've been watching for a while. The red line is a 50-week moving average of the Japanese trade balance. And you can see a correlation as the trade balance is increased, the Japanese yen, the black line, as this goes down, it's actually increasing in value against the dollar. As a trade balance weakened, we saw the Japanese yen weaken against the U.S. dollar or rise. It took more yen to buy $1. So you've seen the correlation, I think, pretty well in here. The correlation changed in a very big way right around the credit crunch time again. And all of a sudden we saw a massive fall off in the trade account in Japan, exporting a lot less because of that global demand change, but we also saw a massive rally in the Japanese yen. And to me, this rally flow on this crisis was this final spurt of repatriation. And I think we're there now. I think all this repatriation has shot its wad. All the crises that hit Japan, the tsunami, the nuclear crisis. So I do think this change is finally for real, and the yen is starting to work higher in here. Don't see. I think this is the old PowerPoint, Morgan. I don't see the currency charts in here, but of late, the yen has rallied just since I prepared this slide, which the date was, I forget the date of this. This is probably about a month ago. But the yen's rallied about 400 pips since then on a real sea change here in what's taking place in a change in perspective of what's taking place in Japan. And I do think this is finally for real. As to positions, we're long dollar yen and have been long dollar yen since around November 6th. This is a trade that I'm telling my clients, this is one of those, a buy and hold trade that's finally starting to work on the fundamentals, which haven't worked very much this year for a lot of the currencies. And how we play something like this is, from my perspective, in terms of advising them, I use both technicals, obviously, Elliott Wave. I trade short-term, give them short-term recommendations and long-term recommendations, and this is a longer-term trade. And when we hit levels in terms of where we may have a correction, my advice is that if you're long several lots here of this currency, it may be an area to lighten up. It may be an area to take some profits, that type of thing. But in general, maintain a core position because the yen is moving on the global fundamentals that make sense to weaken the yen. So we're seeing the yen finally move in line with the fundamental background. So that's where it makes sense. Question from Will, are you trading binary contracts? No, but I like the NADEX for the binaries. The binaries are, I think, a great product for the currencies. If you have a directional view based on not only your technicals, but some of your slightly fundamental trend background and things make sense, the idea of a binary where you can limit your risk, I think is a beautiful thing. So I do like NADEX for that. As I said, this is not the right presentation. There we go. Thanks, Morgan. this is a look at the yen, and we've seen it move since that prior slide when I talked about this in a prior webinar. We've got about a 400-point move in here, and we think this is going to continue. Obviously, there's some profit taking along the way, and the reality is this trade's getting a little bit crowded in here, and crowded. We look at the open interest numbers in the CME to help us get an idea on whether or not we have too many spec interest or not enough. And you can look at the weekly commitment of traders report and find that. What technicals are used? I use Elliott wave analysis, and excuse me a second. I use Elliott wave analysis, and I also use just general trend line stuff. And as I said, I trade very short term and I trade long term. The longer term trades this year have not been working because of this. But you can sample, as I said, and I'll have a slide in the back, one more slide. You can sample the service here, free trial for anybody here, and even a discount on our subscription rate if you want to see what we do. I think just coming in, taking a look at the free trial, you'll see what we do in both the short-term and long-term analysis. We give both technicals and fundamentals analysis. It's hard to describe it all right here. And if we back up real quick, oops, where there it went. Anyway, that's the last slide I show on the yen. I don't see any more of those slides available. But in general, our view is this. We generally think the euro in here has gotten a big boost from the PR going on. Ultimately, we think the euro goes lower on fundamentals, but I'll tell you, it's confounded me all year and has been a big problem. But ultimately, if currencies do trade on interest rate differentials and growth, the euro relative to the U.S., I think goes a lot lower once this rally again is out of the way. I think we're getting close, but I've thought that for a bit in here. Australian dollar, it comes back to China. If China continues to grow and continues to be optimistic, and we're seeing a boost in the Chinese stock market, the Australian dollar can continue to remain supported and even rally in here, despite the fact that the Australian economy is breaking down in a very big way. But the Aussie, to me, has a massive risk premium in it for a while. So I think if this risk premium finally breaks in the Australian dollar, because even now you're seeing the yield differentials decline, which has been a big driver of hot money in the Aussie, and we're seeing that the Reserve Bank of Australia starting to cut rates. Once that premium comes out of the Aussie, and if we find that the global economy isn't growing, that's a time again to get short long-term the Aussie, because I think a lot of premium is going to come out. And it's kind of a similar view on the Canadian dollar. My view on the British pound is ultimately the British pound, British economy is in trouble. Almost 50% of its exports go to the Eurozone. Ultimately, once we get through this period of a little bit of optimism in Europe, because the pound and the euro tend to be so highly correlated of late, once we get through this, I think the pound really breaks in a very, very big way. And again, relative interest rate differentials and relative growth with the U.S., the UK economy could easily slip back into a recession. The question, the Japanese futures contract will explain next week. How do you see next week with tomorrow's elections on the Japanese yen? Who knows, Don? It's hard for me to try to predict that. My only comment is this trade's getting a bit crowded, and often we see, buy the rumor, sell the news. So we may be getting to that setup in the yen. I personally took some money out last week, but still have a longer-term core position. Just as I tell my clients, I basically eat my own pudding, so to speak, and trade, the same stuff with my clients. But we'll just have. I think if you're a long-term player, you don't worry about it, because I do think this trend, and then we've seen a real sea change in the sentiment towards the yen and potential for a sovereign debt crisis in Japan, which I expect in a couple years. I just don't think it can sustain this. So longer term, I like it. Shorter term, a little bit less bullish at the moment. A correction technically looks like it could come into play here and shake some of the later riders out of this. Canadian dollar. Canadian dollar. You know, I used to say they don't call it the loonie for nothing, because it kind of trades in its own orbit and often doesn't trade relative to the pack. And you often see the Canadian dollar do these massive head fakes. It gets in these rallies and technically starts to break out and then snaps right back. It's a very hard currency to trade. In general, I think the Canadian dollar is overvalued relative to the U.S. dollar in here because of the fact we're seeing the housing market start to break down in Canada. The manufacturing numbers in Canada were very soft last time. What's interesting is the level of debt, consumer debt, discretionary debt for the Canadian citizens is much higher than the U.S. So I think there's a potential there. Again, if the global economy does not grow and the U.S. does not drive this, places like Canada with a big premium in them and Australia with a big premium in them, because those two currencies are called commodity currencies. And commodity currencies are more leveraged to global growth than your average currency. So if the global growth disappoints again, I think the Canadian dollar weakens, and that's why we're playing it long term. But in here, I'm waiting for a movement. Some technical movement in here, and I want to get long the Canadian dollar because I think the bottom is definitely in on the Canadian dollar. That said, let me just make one more point, because I think if the U.S. doesn't grow, it's going to affect China in a very negative way. But I do think if you look at a trade, if you're a Canadian dollar citizen and you don't want to mess with the U.S. dollar, take a look at Aussie CAD. That cross, the Aussie has been much stronger than the Canadian dollar. And again, because of its growth premium to China. But if that changes, the Canadian dollar is going to be much more secure. So I think a sleeper trade for people longer term is playing the Aussie CAD and playing it short, expecting the relative movement in Australian dollar shouldn't move as much as it has done relative to CAD. So I think that's a great long-term trade to take the dollar out of the picture and worry about the risk of the dollar. I think that's all I have, Morgan. Thank you very much. Thank you very much for hanging on. I very much appreciate it. And as I said, if you, let me just speak of NADEX chart up here. I think currency trading on NADEX is really a great product. Now, there's no doubt it's just a pure directional bet, but that's the way I trade. I do directional bets in general. I'm not much on options because I don't know a lot about options. It's just not an area, you can only learn so much, and it's not an area I know much about. But I do like the binaries because I do have a directional bias each week. And the fact that you can make a directional bias trade and you know exactly what your risk is by buying a put or buying a call in here, to me, it's a beautiful thing, and I really do like NADEX for trading. And they have really everything you would want. The major crosses that move the most in the major currencies. So. And as I said, if you just come to our website and ask for a free trial there, or send me an email at info@Black Swan Trading, I'll be happy to give you a free trial on the service. And if you like the service and you say you came here from TradingPub, we'll give you a 20% discount on the annual subscription. And I'm available all the time, so don't be afraid to email me if you're testing the service and you say, Jack, that was a stupid idea. Why did you do that? Or I like that, or I don't understand that. I try and be as interactive as possible with our clients.
All right, great.
And help along the way.
Okay, great. Thank you, Jack. And again, a great way to wrap up today's event. And you know, it's interesting. We had some excellent speakers. You know, we started off with Jake Peavy, then we had Dan Cook of NADEX, we had Mark Sebastian of OptionFit, Marcello from Day Trading Academy, now Jack from Black Swan. And you know, I really appreciate what you guys said. You know, somebody said the professional presentations today have been as good as I've seen anywhere. This has been a Saturday morning well spent. Somebody else said, yep, completely agree. Other trading webinars are too basic in nature. This is by far the best one I've sat through. And that's really what we try to do with our Saturday classes. And you know, we don't just pick these guys off the street. The reason we have people like Jack and Marcello and Dan and Mark here is because you know, they do an excellent job in educating and sharing about the markets and giving you guys things that you can actually take away. And I hope that you will let them know how much you appreciate them being here, that you'll check out their websites and you know, try to learn more from them. Again, like I said, we wouldn't have them on here if we didn't think that they would do a good job for you. So great job to all the presenters. We did record today's event. Normally I would say I'd get it uploaded today or this afternoon, but because it is a longer recording, it was about 3 hours of pretty much hardcore education. It'll probably be sometime Monday that we get it uploaded, but we'll upload that to our website, which is, if you go to our site, it's tradingpub.com, and you click on the free education at the top, then we'll get it uploaded to there. We'll get it, and we'll also post it if you want to help us. We're getting close to about 30,000 likes on Facebook. If you want to like us there, we'll post it on our Facebook page as well as soon as it's uploaded. So I appreciate you guys being here. All we really ask of you is that you tell your friends about us and you go learn more from these guys like Jack and Marcello and Mark and Dan. And again, just a quick one last reminder, if you want to join us, we're going to have a live trading session on Monday. If you enjoyed this, we'll do a live trading session on Nadex. We'll look at some of those contracts that Jack mentioned, and you just go to that website. It's tradingpub.com/Nadex. I'll type in a couple more links here just to kind of remind you. If you go to blackswantrading.com, that's Jack's website, and then if you remember, Marcello was kind enough to offer that opportunity, and I'm going to find that link for you. So give me 1 second here. There you go. I'll type his link, and then also, if you remember, Dan and Mark Sebastian had some special links for you. I'll type those in as well. I know that you know, in the heat of the presentation, you might not have gotten a chance to check them out. So I'm just scrolling back through there, and we'll get those links updated for you, and you can kind of take a look at them. When you exit the room, it'll give you the opportunity, or it should give you the opportunity to register for our Monday event. All right, there is that event for Mark. So here's all the links that we have for you, and I'll type it in one more time where they're all together, and you should see that. All right, good deal. So we appreciate you guys being here. We'll get it uploaded very soon, and thanks again for taking the time to be with us.